Okay, so we are doing question number 9, preparing detailed ledger account. Ross owns a music business. His business's statement of financial position is as follows. So this statement of financial position actually tells you how much is the balance in the company. So for example, as you can see, all of these are the assets of Ross, whereby there's a premise of 90,000, equipment of 12,000, vehicle of 9,000, bank 3,300, cash 700. All of these are assets, so they have debit balances. So later when we do our T account, which is our ledgers, we need to write the balance on the debit side. Then we have capital 100,000, liability, a bank loan that is 15,000. All of these are on the credit side of the T account. So when we do our ledgers, this will fall, the balance brought down will fall on the credit side. Okay, the following transaction occurred during the next few days. January 2nd, we paid 1,000 of the bank loan transferring funds from the business's bank account. Before you start here, okay, you need to go down to read what is required for you to do. Prepare detailed ledger account to record this information, record dates. So when you see the word ledger accounts, this means T accounts. T accounts. Okay, so now we need to do all of these. Open additional accounts if necessary. Use the abbreviation debit or credit in the accounts title. Prepare new classified statement of position 7 January 2018 when all the transaction has been recorded. Assume bank loan is a long-term liability. Okay, because this one we need a classified one. Classified long-term liability means it is a non-current liability. No worries, we'll get back to this after this. Liability. So first we need to do all the balances. Bring all the balances out first. So you can see we start with premises 90,000, equipment 12,000, vehicle 9,000, date balance brought down. Brought down means it's from a previous time or previous period. And then bank, cash, all of these balances all done. So if you look at question number 1, I've also done it for you. You can see we paid 1,000 bank loan transferring funds from business's bank account. Bank loan, bank account, come out the money. It means you paid using bank account, which is on the credit side. Paid for what? Bank loan. On what date? This date. So when you do it, you need to do your double entry. You credit one side, you need to debit another account. Okay, so now we need to debit into bank loans account $1,000 from bank. All right. Then next, on January 3rd, so I'm going to label this as green in color, purchase some additional equipment. So your equipment will increase on credit for 4,100. So you need to go to your equipment account first. Right, 4,100 increase on January 3rd. How? From where? Where did we buy it from? So we owe people money, so we call it trade payables. So we need to open a trade payables account right here. Trade payables. So we're going to write 4,100 equipment January 3rd. Okay, next one. Ross withdrew $300 cash for private use. So let's change the color to another color. Let's put it blue in color. Withdrew cash. So cash need to go out $300. And the date would be on the 4th of January. Okay, we don't have a drawings account yet because we have not learned it. So we're going to just put it into our capital account. So it means that we take out some of the capital money and withdraw it out of the business. So we're going to debit capital 300 here and write cash January 4th, 2018. So done. Next one on the 5th. We have to look here. Sold some unwanted equipment, $500 on credit. On credit, again, now we are selling it out. So we're going to use our equipment. We're going to sell out $500 worth of equipment on the 5th of January, 2018. People that owe us money are called trade receivable. Okay, now we need to go here, trade receivables. So on the debit side, 500, because they bought equipment, they owe us $500. So you put it on the debit side as an asset, 5th January 2018. And the next one, Ross introduced additional capital. It means that you bring in new money. Okay, you bring in new money from yourself. It's a private person. You bring money into your business. Okay, private funds. This is what we call private funds. You put it inside the bank account. Okay, so it'll be 4,000 inside the bank account. Let's change this to purple in color. 4,000 will be added into your bank account under capital, because we put in more money into the business. We said, hey, the business needs more money, so we're just going to put in $4,000 into the business and bank account gets the money, January 6th. And then the next one will be transferred $200 cash into your bank account, pink in color. So cash will go out $200. Go where? Go to your bank account. What's the date? 7th. So go to your bank account, get $200 from where? Cash account on the 7th. So up till here, you should be able to complete question number 2 up till number 7. So now we need to create a classified statement of financial position. So we have to label all of them. If it is a long-term asset, we're going to call it non-current asset. So I'm just going to start labeling all of them in this color. So this is a non-current asset, vehicle, non-current asset, bank, current asset, because we use them very often, cash, current asset, ups and downs very often, capital is capital, bank loan, they said it's a non-current liability because it's long-term. Trade payable is a current liability, trade receivable is a current asset. So now we need to classify them in a statement of financial position. So now we need to put in non-current asset first. Non-current asset. We put it in here and we're going to label. The first one is premises. We're going to write all the name. Premises, equipment, vehicle, and then go current asset, bank, cash, trade receivable. Next is capital, then non-current liabilities, bank loan, current liability, trade payable. So now I'm going to put in every single item, then we're going to calculate. So let's look at premises. Nothing has changed. So I'm just going to write 90,000. Okay, equipment, something has changed. So I need to calculate how much is equipment. So as you can see, it is 12,000 in the beginning. And then I need to add 4,100. Then I need to minus 500. So I get 15,600. This is the balance that I have. Same goes, vehicles is the same thing, 9,000. So I just take this, add 9,000. I add another 90,000. That's my total non-current asset, 114,600. Done. Then go to current asset. Look at my bank, 3,300 plus 4,000 plus 200 minus 1,000, 6,500. Cash is 200. Trade receivable is 500, 7,200. Add them together, we should get 121,800. So this is my total asset and current asset and non-current asset. And then let's go to capital. Capital is 104,000 minus 300. 103,700. And then our bank loan is 14,000. So I'm just going to put it here. So we're going to add it at 14,000. 117,700. Trade payable is 4,100. Add them together, 121,800. So you can see when these two numbers are the same, we are in the clear and we have done everything correctly.